in many ways to systems that the traditional hedge funds, sovereigns, and so on are used to interacting with, and that is now available in the marketplace. And then safe and secure custody and storage. We've read many times about numerous platforms being hacked or compromised. Again, that has really evolved, and as has all of the other compliance and risk-based controls that are required to operate a proper platform in a properly regulated market. So market surveillance, transaction monitoring, all that. So it's really those things that actually allow the institutional segment to engage in the space. Volatility, in fact, presents opportunity. And much unlike, if I look back at 2017 and 18, and we saw this meteoric rise sort of drive a lot of Bitcoin and cryptocurrency conversations into mainstream environment. What happened was, as soon as the prices came off hard, institutional interest waned. That is absolutely not the case this time around. And certainly in our business, both in our direct to customer business, where we deal and onboard with traditional hedge funds, family offices, long onlys, and the like, we've seen exponential interest. But particularly in our software as a service business, where we put our technology in the hands of large-scale traditional finance intermediaries who are now taking digital assets to their customers. And a couple of examples would be DBS Bank, largest bank in Southeast Asia, as well as a joint venture with Standard Chartered Bank. And there's a list more of who are lining up to really play a material role in this space, and that is continuing aggressively.
Yeah, so that's interesting. So you're saying that the difference this time to previous pullbacks is that institutional interest is actually increasing as opposed to dropping away. And secondly, it's the intermediaries that are going to be doing the marketing for you versus your own direct marketing efforts, and that is interesting. And impossible to have this panel without kind of talking a little bit about regulation. Maybe we'll get onto that in a second. But first, I just wanted to ask Sam, I listened to a recent podcast with you on the Wolf of Wall Street. You were talking a lot about risk management. And one of the risks that you didn't mention there, Wayne, is obviously counterparty risk. You as an exchange, Sam, you're obviously offering, quite a lot of leveraged margin trading through the platform. I think it would be helpful to maybe just sort of set the scene. How do you think about collateralizing those exposures? How do you manage your risk? Maybe just for the audience, give us a quick rundown.
Totally. So it's a pretty different system than what you traditionally find in finance. And I think in a healthy way, I think it's a better system, but it is different one way or another. And in particular, rather than having what you usually see where you have a pretty intermediated process where there's separate clearing firm, custodian, exchange, broker, and the sort of language of terminology differs based on what's whether you're talking about securities or futures. In crypto, the norm is a full stack product. And that's what we have at FTX. We are everything from the clearing, the custody, the deposits and withdrawals, the risk engine, liquidations, and the matching engine and the customer onboarding and compliance and KYC and everything else. And that has pretty profound impact for what the space ultimately looks like. Among other things, we are in a position where, when you look at sort of like what are some of the problems that Robinhood ran into on the day that, they had to turn off buying of GameStop and other assets, they don't own most of their infrastructure, right? Like they don't own their, the assets don't sit generally with them. They're not the exchange. They're a broker, they're a mobile broker that sits between, the users and sort of most of the back-end infrastructure. And so there were real questions about the clearing and settlement of sort of all of the assets between a bunch of different counterparties. And those became pretty nasty questions that sort of didn't have great resolutions. And then you get notions of like, well, what if someone falls down? What if they don't have the capital they say they had? What if they don't pay up? With FTX, when people trade futures on FTX, they deposit their collateral to FTX. And so we ourselves take deposit of those assets and hold them. and confirm that they are what the customer says they are. We don't care what they say they are. We just care what they actually are. What we actually see hit our bank account, hit our system. And then we have a real-time risk engine, which is running 24/7, and liquidating people if necessary. And that's a very different system than what you traditionally see. It means that we're not so much worried about what happens if we try and margin call a customer and they don't deliver. They can't not deliver. That's not really an option. We already have their collateral. And so instead what we're thinking is basically just well, how do we make sure that, if we have to do a margin call, that we do it in time, that we do it before a client runs out of assets, not after. And that sort of is really our core role as an exchange from the risk perspective is, well, people are putting on positions. If someone puts on a $100 million Bitcoin futures position and they back it with $20 million of collateral, we hold that collateral. And if markets start moving against them and we think that, that position is in danger, then we need to liquidate that position on the order book. And so we're thinking about, well, in the 10 minutes that it could take us to execute a liquidation, how much could markets move? How do we make sure that that client doesn't have their account go underwater? And so far we've been mostly successful with that.
And so that's interesting. And another area which I think you have often spoken about is latency and the advantage of 24/7 markets in yep. risk management. How much of a role does that play? Can you talk to us about that for a second?
It plays a pretty big role, and a big thing is that if you can execute a liquidation as we do in a minute, right? Then what you're thinking about is, well, how much could markets move in that 1 minute? If a client has $5 million backing a $100 million Bitcoin futures position, that might seem pretty risky, right? 20x leverage on a volatile asset. But the truth is that 5% is actually quite a big move for Bitcoin on the timescale of 1 minute, which is how long it would actually take for us to execute that liquidation. When you look at what happens if someone put on a 20x leveraged Bitcoin futures position on the CME at 3:30 p.m. on a Friday, right? Markets close half an hour later, and then it's going to be 2-3 days before any could even theoretically happen to margin call that user, right? And so you have to be worried about not a minute of volatility. You have to be worried about half a week of volatility, right? What if a war breaks out over the weekend, and all of a sudden by the time risk management gets back into the office on Monday, lots of clients are underwater? And so it really de-risks the system to be able to operate 24/7, from risk management perspective. And that's something which is, somewhat unique to how the crypto industry operates today. It's not how traditional finance operates, but I think it's actually quite a bit safer on the risk side.
Yeah, so in a sense, it's so two things you mentioned there. One, the ability, sort of almost a latecomer advantage at having, finance obviously developed over a very long period of time. That's led to a bit of a mishmash of the financial services infrastructure with a lot of providers and a lot of mouths to feed through the chain. You're able to eliminate a lot of those inefficiencies, provide a full stack solution, and then the 24/7 nature of markets actually reduces your risk profile overall.
Yeah, I think that's absolutely right.
So that's very interesting, and thank you for sharing. And Jason, perhaps I could just turn to you. As co-head of trading at Galaxy Digital, obviously volatility does bring opportunity, as Wayne alluded to earlier. It must, one assumes it's been a reasonably profitable period for you then over the last month or so. I won't ask you to comment on that, but how do you deal with some of those liquidity risks that do come in? And could I also ask you the other question just on adoption? What types of clients are you seeing get into this? Are we moving from the quant space into more the traditional institutional space? How about sovereigns? We do have some on this call, so to the extent that you can talk to us about some of that would be helpful.
Absolutely. To hit on a couple of points. One, to just kind of circle back to the 24/7 issue and some of the challenges that creates, as well as opportunities. It's great for managing risk for those of us that are in the system. Where it creates issues are traditional market players who step in and are, their banking doesn't necessarily work on Saturday or Sunday. And that's where we have to come in and either be a bridge or create interesting solutions. And to that end, talking about adoption and who's stepping into the space, really look at it kind of in a bifurcated way. You have the crypto natives that Michael spoke of, at the onset, who are looking for the next trade, the next edge, the innovation, trying to stay on the bleeding edge. And then you have what we'll call the TradFi people who are now stepping into the space. And so what you have is really a spread, because the things that the crypto native clients want isn't necessarily what the traditional market players want, where they're concerned about custody and regulation, where the crypto native players are like, how do I get to the next hot thing? How do I get access? Can you provide me leverage? Things of that nature. And so when you start to compare the two and balancing those competing forces, it's challenging, but it also, I think, allows for a greater view of the space. And then to speak to sovereigns, we're certainly seeing sovereigns, showing increasing interest, looking for ways to get into the space that makes sense, whether it's on the mining side where they're using natural resources or things of that nature, and trying to take their country specific resources to the next level. And you also see it as a way to people looking at this as an asset class, and they're finally saying, hey, we need to allocate a portion of this, whether it's a hedge against inflation or whether it's something else, right? Like to just diversify away. So we're seeing increasing interest across, the full spectrum.
So hedge versus inflation, that's an interesting point. We spend a lot of time on our side looking at correlations. I'm sure you do too. The hedge versus inflation argument, certainly for Bitcoin, seems to be, well, it's not standing up at the moment. Are you seeing anything either versus inflation or other correlations? How are things evolving as more and more people get involved in the space?
Well, I think that right now you see large flows from time to time, chunky flows, and it's centered around what is the Federal Reserve going to do? How are things going to work? And I think those were some of the same forces that were pushing it higher as Prussian traders were saying, hey, inflation is a real thing here, and maybe it's not transitory. And that's what you were seeing middle to Q3 rolling into the end of the year. At least we were seeing that from institutional players that we service. And now you're seeing people like change their view and saying, hey, this Fed, like we've never done this before. What does this mean? And when you look at risk off in general in the broader market, it's really easy to sell your crypto portfolio, not so easy to necessarily sell your Monet. And so from that standpoint, it's a very easy source of liquidity. So in that sense, sometimes we become a victim of our own success.
Yeah, that's interesting, and certainly not new. In traditional finance as well, you always sell your winners is always what happens. So circling back to Michael, I thought it might also, just before we kind of leave the market infrastructure and move on to competition and customer acquisition and regulation, I thought it might be interesting just to hear from a geographical perspective, what are the adoption trends and what changes are there? Is it unique? I mean, obviously there's a regulatory difference in terms of the evolution of regs in different markets, and we can get into that as well. But are you seeing any differences? Clearly, China has a different philosophy here versus the West and Europe and so on. So would you call anything out as being specifically worth talking about in geographical adoption?
Sure. When it comes to for the Genesis business, kind of spot trading and like kind of the cash markets is really kind of focused around the kind of a U.S. space, given that we're a U.S. firm and headquartered in New York. Where it gets interesting is that sort of our borrowing and lending business is actually more than 50% non-U.S. With a tremendous level of sort of client activity coming out of Asia. So whether that's in areas specifically like Hong Kong. So there is kind of diversity around our clients based on kind of our business line, and certainly it kind of gets interesting because a lot of folks will post crypto as collateral to get like a different crypto borrow. Where kind of the fiat on-ramp, off-ramp isn't necessarily like a gating item, whereas it might be on the spot side for folks that aren't kind of used to trading with stable coins, kind of the USDCs of the world. And so we've seen a tremendous amount of kind of interest around our business coming out of Asia. Where it's kind of lagging currently is kind of in the EMEA sector. So Europe and kind of Middle East, Africa. Part of that is, kind of the client profile of folks who tend to kind of interact with Genesis. At the same time, you take a financial hotbed like London, the amount of tremendous capital that's there and the enthusiasm that's there. But, the FCA's kind of attitude towards crypto makes it difficult, I think, for kind of the institutions to really want to kind of take off and really kind of get involved. And so, I know we're getting into the regulatory stuff shortly, but kind of the tone of kind of the regulatory and kind of government bodies does have an effect, positively and negatively, I think, on, kind of growth and adoption ultimately of the asset class within various geographies.
Okay, so maybe it's time to go there and let's talk about regulation, I guess, for a bit. Wayne, what are the hot topics? I guess, well-crafted regulation is clearly something that's desired. Provides clarity, certainly from an institutional adoption perspective. We've all talked about it, and we all welcome that. But given the pace of development, the rapid innovation happening in DeFi, etc., presumably the risk is we end up with something a lot more heavy-handed than that to try and kind of rein it in, because your first foot forward is necessarily going to be a little bit clumsy. Agree or disagree, and how do you think? You said you took your regulatory pain early, so you should be pretty qualified to tell us how was the experience and how's it playing out?
Yeah, well, that regulatory journey certainly earned most of my grey hairs that I'm sporting these days. But look, I think regulators struggle to keep pace with rapid changes in technology across the spectrum. And crypto and digital assets is frankly a great expose, if you will, but certainly it's not unique to our space. I guess our view as a firm is that in order for digital assets, crypto, to really go mainstream, right, properly become ubiquitous across the world, regulation is absolutely going to need to be well and truly in place in all major markets. And frankly, when many of us began this journey 10 plus years ago, that was not necessarily a certain outcome. Fast forward the clock to 2022, and it is absolutely certain that all major markets around the world will regulate this asset class and will regulate it properly. Now, for us in Hong Kong, it was 12 months ago that we obtained broker dealing and exchange licensing specifically for digital assets, or virtual assets as the SFC, the Hong Kong version of the SEC calls it. And to this day, we remain the only license holder 12 months later. And the reason for that, frankly, is because the bar that has been set by the SFC is, in my view, by far and away the highest regulatory bar set anywhere in the world. And so, whilst it's partially restrictive in some areas, it provides an extraordinarily high level of investor protection, and that gives the real significant institutions the confidence that they need to actually enter and engage in the space. So, there's a whole raft of things that we need to comply with, including having a minimum of 95% insurance on the assets that we hold on platform. All of our customers have to engage in suitability tests. There's SOC 2, like a whole bunch of things that are not only all type 1 traditional brokers must comply with. We must comply with all of those things, but in addition, a host of crypto specific controls. Now, for us, we feel like it's probably unlikely that all major markets around the world will adopt quite the same level of controls over the long term. And in fact, we fully expect and anticipate the SFC to evolve their stance, right? That their utmost concern is delivering investor protection in the short term, and then evolving and making that licensing framework, I guess, more applicable to the mass market over time. And that there's no doubt that will happen. In other markets around the world, we've actually seen a couple of things take place. One, some have indicated perhaps a slightly lighter touch regulatory framework, and then have actually seen what Hong Kong and other markets have done and said, hang on a second, we actually need to lift the bar. And I think Singapore is probably a good example of that, but there's numerous other markets around the world that I think are definitely going to strike a different balance to perhaps what they have in the past, and lean more towards investor protection, whilst obviously still trying to encourage the technological advancement and development, right? So it's a fine balance, but I guess for us, we kind of feel pretty good about things, having complied with the hardest anywhere in the world as we sort of shift and sort of operate in multiple other markets. Pretty well placed, I think, to do that with a high degree of confidence.
Yeah, so that's really interesting, Wayne. Thank you. Thanks for sharing that experience, and also the little snip about Singapore coming in easy and then lifting. So we sort of find some kind of commonality. Maybe I'll sort of just turn to Sam. I think Sam, obviously you spent some time on the Hill. I think I think the quote was that 80% of regulators are spending 10% of their time on crypto now, up from nothing. What are you seeing, and maybe more from the US side? Are they treading their own path? Are they also looking around to see what others are doing, or what are we going to get?
It's super interesting, and I think that regulation is probably going to be the most important thing for the sector over the next year or two. We're seeing lots of changes in a large number of jurisdictions as place after place starts to think about what their stance is going to be long term towards cryptocurrencies and how they're going to regulate them. And I completely agree that we're in a place where they are clearly going to be regulated. It's a matter of how and when, not if. In terms of how things are looking in the States, the US has a somewhat sort of unique regulatory framework for marketplaces. In particular, it has two different primary markets regulators, the SEC and the CFTC. The SEC regulates securities, the CFTC regulates commodity futures venues. And we're seeing sort of different paths in the two of them. And in general, also, I think a fair bit of confusion over some auxiliary assets in the ecosystem. One big question is stablecoins. There's been a lot of talk about stablecoins, about regulating them. There's not been a lot of very concrete progress made towards how that's going to happen. It's been more just sort of statements that it will happen. But especially given the somewhat fragmented nature of markets regulation in the US, it's not clear which body, if or whether it will be multiple, that will end up with jurisdiction there. On the futures side, there's a pretty well-defined regulatory framework from the CFTC. It is one of the most stringent in the world. I think it is certainly one of the most thorough. There's a fairly small number of licensed entities through it. We are one of those through FTX US Derivatives, formerly LedgerX, which is a CFTC licensed futures venue, and are excited to work with the Commission on building out that product base. I think it could really do a ton to bring liquidity and volume onshore, whereas traditionally in crypto it's been almost entirely offshore. I think that there's a lot of open questions about how the rest of the space is going to evolve. I think on the commodities futures side, there's a fairly straightforward pathway that looks very similar to what you see with futures on oil, futures on gold, and other things in that framework. But I think that when you get to digital assets that might or might not be commodities, might or might not be securities, have some properties of one, have some properties of another, I think that's where it starts to get pretty complicated, and where it starts to get pretty unclear exactly what's going to happen long term there. And that's not to say it's all a free for all and who knows what could happen. Anything could happen. But I do think that there is substantial uncertainty over a lot of that, and that is sort of like having pretty big impact on what the space will look like in the States going forward. I think that people are very sensitive to this fact, and it's caused sort of a much slower growth of a crypto ecosystem in the U.S. than I think you otherwise would have seen. And I think there's been a fair bit of frustration bilaterally between regulators and industry about what standards are being used. I think both have felt frustrated with the other. I'm optimistic that there's going to be a framework that will come out of this in the next year or two, and in particular that we're going to see a registration framework for assets that have some security like properties, and sort of other pretty straightforward things. But we're not there yet, and I think it's going to take some time for everything to get there.
Yeah. Yes. And you'd also mentioned, I think, in a recent discussion, you'd sort of mentioned some concerns about the regulation of the on-off ramps. Is that still a current concern? What are you hearing? What do you think are the right and the wrong outcomes there?
So that's an interesting one, because it's not literally speaking the regulation of them. It's not that there are statutes prohibiting a bank from offering a multi-currency global bank account to a cryptocurrency industry company. But in practice, that is quite rare, because in practice, there's a lot of hesitancy on the part of those companies to service the crypto industry. There's a lot of uncertainty on their part about exactly what is and isn't okay there. And so I think that there's a long way to go in terms of providing the sort of clarity there and comfort that I think, we would love to see. We're not there yet. Hopefully we will get there over the next couple of years. And until then, I think I'm really interested to see how a lot of that plays out.
Yeah. Jason, I had a question for you. I mean, we're talking about regulations, and this industry is nothing if not innovative. One of the big, I guess, institutional barriers to entry, certainly according to various industry surveys, is of course AML, money laundering, KYC. I'm very interested in the recent development just around Aave Arc. They, for the listeners, they offer a DeFi solution to trade digital assets, which has a sort of embedded KYC, both onboarding but also ongoing monitoring service, which is associated. I understand Galaxy recently bought Bluefire, which I think is one of the 30 kind of early adopters that have been approved by Fireblocks, which is the whitelisting service that verifies and beneficial owners, etc., and monitors on an ongoing basis. So is that a solution to the KYC problem? Are we going to see more like that? I just sort of be curious to get your thoughts.
Yeah, I think that as we attack this and we look at this from an AML KYC perspective, and you look at DeFi, there is a need for, in a lot of ways, innovation to kind of at least try to drag or bring along the best practices from TradFi, and that is certainly one of them. And I think that you're going to continue to see various solutions, because not all of them answer every question, and it's really one of those. It's so important to what we all do and what we all want to do, because no one wants to violate that it's going to be iterative and it's going to continue to improve. So Aave Arc will address one solution, but it doesn't address all of them. And so you're going to need to have innovation continue, and you're seeing some of the smartest minds in the space actually working on that as we speak. And so it's really important to open that up to to the world, because you can't have this thing closed off to a subset of people that are operating offshore or in certain jurisdictions, and everyone else who's playing by a different set of rules not really have access or run the risk because there isn't regulatory clarity around it. And so I think you're going to continue to see movement. It's the first of many, but there will be many to follow.
And so, do you see, speaking somewhat selfishly, as a salesperson, I would love to see similar sort of innovation in the KYC space in traditional finance. Do you see the opportunity for some of this innovation to get reverse engineered back into traditional spheres?
Yeah, absolutely. And I think that all the panelists will all agree that what you're seeing in the crypto universe or ecosystem, such an overused word, but what you're seeing here is truly going to revolutionize what we're seeing in TradFi. Crypto is going to do to finance what the internet did to retail. It's going to change meaningfully and markedly the way people interact, and it's going to be a combination of the innovators, like the people on this call, as well as the traditional people, and working together. You saw what Sam did with FTX and going after LedgerX, and you're seeing other smart players follow suit, embracing regulated venues. I think that we're all going to work together, and you're going to see best practices in each space kind of co-populate till this becomes one thing at some point in the future.
Yeah, I think Christine would be delighted to hear you say that. So thanks for that, Jason. Michael, maybe we could just sort of turn a little bit to the competitive landscape. We've obviously seen some consolidation of active centralized exchanges. Meanwhile, the DEX universe continues to expand. How do you see that competitive landscape playing out across the two? And again, from an institutional perspective, how do you see sort of comfort in the DeFi world? I know that you've spoken in the past about some of the risks through some of the rug pulls and things like that as preventing adoption. Have we addressed that? How far are we down the curve?
So there's two different questions. I'll try to tackle the first question kind of around geography and consolidation. I actually thought we would have seen more consolidation by now. And the fact that we still have dozens and dozens of exchanges kind of around the world was a surprise to me. Certainly, kind of sitting here in January of 22. However, what used to be was kind of a relatively fragmented market with kind of exchanges, dominant exchanges in various geographies around the world, and it was kind of necessarily that way because I think rules and regulations and laws are different in lots of geographies, and doing a roll up respecting kind of each's laws and rules would have been difficult, certainly 4 or 5 years ago. What you're seeing now, though, is you are seeing some consolidation. You are seeing, call it, crypto company Asia, crypto company Africa, crypto company, Europe and US, and sort of creating geographies within a consolidated, holding company type of structure. And I think you'll kind of continue to see companies acquire businesses, potentially keep them operated separately, and kind of be branded separately. Certainly for regulatory reasons, but I do think you will see continued kind of consolidation, throughout 2022. But the fact is, the biggest exchanges have been so successful that they're incredibly expensive to buy. Right. So it's not as if kind of valuation is cheap as you look to buy kind of the winners within various geographies. As it relates to DeFi, I think the pickup in adoption, certainly among the retail end of the market, has been tremendous. Institutionally, I feel like there are firms that are very comfortable engaging directly with DEXs. There are firms that aren't quite there yet, but want to own, Compound or Aave or Uniswap kind of within their portfolio, just for kind of price exposure to various tokens. And then there's kind of the guys that are I can't ever face I'm not even there. What's Bitcoin, right? And frankly, like that's the group that frankly has the most money kind of behind in that category. So it's a tremendous kind of like dry powder that's kind of on the sidelines. But they still point to rug pulls certainly is a risk. Lack of a counterparty, like what's considered a feature in DeFi is a bug for a lot of traditional investors that like need somebody to sue. Like something goes wrong, I gotta call somebody. And the fact that there's no like central body kind of sitting behind, some of these pools makes it really impossible for a lot of these traditional investors to kind of get involved. And so fundamentally, the way DeFi has kind of been designed, I'm not sure a lot of these traditional investors can ever get involved if there's nobody to like take to court if something goes wrong.
Yeah. No, that's interesting. The feature versus bug argument is a great point. Sam, I couldn't help but notice a small smirk when Michael mentioned that the successful exchanges are now very valuable. You've obviously been expanding into other areas. You recently bought FTX Ventures. Maybe tell us a little bit about that and a little bit about the product evolution at FTX over the next few. What are your opportunities?
Yeah, I mean, a lot of this is intertwined with the regulatory frameworks.
Sure.
A big part of this are products that we have ready to go technologically, but are pending, conversations with regulatory bodies in a number of places. I think the things that, I'm most expecting to see, and one piece of this is, hopefully a rollout of futures products in the United States, which I'm super, super excited about, pending more conversations with the CFTC. A second thing that I'm really excited about is to see, integration starting between, blockchain platforms and, video games and other sort of natively digital content providers, social media and other platforms, the thing people are calling the metaverse right now. I think we're going to start to see steps in that direction. We're having conversations with a number of partners about ways that FTX US NFTs can power those services. So really excited to see those develop. Excited to look into other products that we can launch on FTX US, including stocks. The last thing I'll say is to hopefully provide a really compelling integrated financial experience for consumers that in sort of a seamless way can give them direct access to financial markets, from cryptocurrencies to equities, to interest rate products and other things in a way that they've not traditionally been able to access except through sort of expensive intermediaries.
So FTX NFT powered social media is something I took away from that. How does that work? Sorry.
Yeah. So I don't know is one answer. I can bullshit. I can give you some thoughts, but really we'll see what happens. But if I had to throw some stuff out there, I'd say, look, you have basically you could start out by putting the actual messaging from social media networks on chain, right? The actual text back and forth is not something that would break a blockchain to put on. There's not super throughput intensive. That would allow interoperability between different social media platforms. Super exciting. You could read a Twitter, you could read a tweet on Facebook. And that would also start to allow it to interact natively with other blockchain-based systems, with financial or non-financial, in sort of an integrated way, which I think would be super cool and powerful as well. So I'm really excited to see that start rolling out bit by bit in various places.
Yeah, interesting. Okay, so I guess as we sort of get into the last 10 minutes of the call, I wanted to maybe just take a bit of a forward looking view and maybe start with Jason. I mean, in terms of the events over the next 6 or 12 months, what are you looking for? Is it ETH 2.0 and sharding, and is that going to be the event of the year, or are there other developments that you have in your calendar that we should be paying attention to?
Well, yes, that is definitely one of the big ones that's on everyone's radar. But I'm going to actually, throw a bone back to TradeFi here and say the Fed is going to be going to have a huge effect on everything. And as crypto has become, what I'll call a real asset, however you want to think about that, that's going to really drive what happens. And so, that's one of the things that's front and center on our radar, because part of being innovative and growing in the ecosystem also means you have to be part of that ecosystem. And being part of the whole broader financial ecosystem means that things that happen like that truly impact what happens to our business. And so I think that's one of the big things that people are looking at how that plays out in the next 90 to 180 days and what effects that will have in terms of interesting things in the ecosystem. I think that, to the, Sam's point about NFTs and how that's starting to, or how it really grabbed the world, took the world by storm, but there'll be more innovations that come out of that. And there'll be more things that develop as we move forward. So I think looking at, one, the broader overarching macro theories, as well as things that are sprouting up that are really interesting and changing the way people look at the world.
So really, for you, it's about more integration, tighter correlations in a way with traditional finance, traditional markets, and an ever closer infrastructure.
Yeah, I think that part of becoming a real asset class also means you're affected by the same things that hurt or affect other real assets.
Well, welcome back, I suppose, in that case. Michael, how about you? What do you see in the 12 months ahead, either for Genesis or for the sector?
I'll offer both. Certainly for Genesis, we're still going down the kind of the prime broker path. Prime brokerage and true cross margining remains kind of the holy grail for institutional investors. And while there are elements of it that kind of exist within the ecosystem, I do think that there's still lots of innovation and progress to kind of be made there to kind of get this space for lots of different reasons, for access to liquidity and capital efficiency and things like that. For the space generally, I'm really interested in DeFi derivatives. I do think that that's a huge area of growth opportunity that I think we'll see in 2022. We've seen, tremendous, I think, kind of volume growth in things like Mango and DYDX and platforms like that for linear derivatives. And I do think that there's lots of smaller startups in the DeFi derivative world that will also kind of get traction in 2022. And so how those kind of intersect with kind of the CeFi derivative world is something that I'm closely watching for the industry this year.
Okay. So cross margining and do you think that? I mean, you mentioned multiple hurdles to that. Are they regulatory? Are they infrastructural? Are they tech? What are the?
All of the above. I'll check the box for all of the above. For Genesis, we operate a broker dealer within the U.S. So the SEC and FINRA have lots of questions about ultimately what we're doing. Obviously, our lending and borrowing business, lots of kind of questions from regulators for that business. The custody business is regulated by the FCA in the UK. And we also have a license pending with the MAS in Singapore for our business. And so ultimately, depending upon who you're serving, what clients, what jurisdictions, kind of tells you what you can serve and what you can offer and what your technology is allowed to do. And frankly, as we kind of continue to create products for institutional investors, regulation as well as customer demand almost forces you to kind of recreate what exists in TradFi, but kind of the crypto form of it. And so I think we'll continue to see those two worlds converging, I think, in 2022.
So more convergence, great. And Wayne, I know that you've been fairly active on the hiring front recently. Plenty of press about that. What are you seeing in terms of talent out there? What kind of people are you hiring? What kind of people can't you hire that you'd like to, etc. And what else have you got on the palette for the next 12?
Yeah, good question. I think there's probably a couple of bits, I keep banging on about regulation, right? The ramifications of that rolling out more aggressively this year can't be understated. Obviously increasing institutional adoption. I think a lot of the flows and volumes, and frankly P&L that have perhaps been won in the past by light touch or no touch KYC type players will migrate towards the more professional and regulated players in the space, and that is an absolute certainty. But another thing about regulation, what it will do, will actually start to regulate away some of the volatility in the space, to be honest, because highly leveraged instruments being offered to grandmas and whatnot is something that generally raises the eyebrows of proper tier one regulators. So it doesn't mean that there's no room for leverage. I think as Sam touched on before, if you've got really strong risk controls and frankly a proper understanding of how to manage these risks, we can sensibly offer leverage. Cross margining, for example, as Michael just touched on as well, is something that we'll be rolling out to clients in the next few months. These things are possible if you approach them properly. On the question of hiring, look, it's fantastic to see the talent coming into the digital asset ecosystem, often from the TradFi world. And for us, I think, perhaps we present in a slightly unique capacity, having taken a very, very careful approach to regulation and so on. A lot of the high quality talent that comes from that traditional space who have very, very deep interest and connectivity into crypto. I think for us, we perhaps present as a compelling sort of place to be. And so, super excited to have announced our recent very senior hires, but plenty more to come.
That's great to hear. It's certainly look from where I sit, it's certainly helpful to have ex colleagues, friends, etc., clients more and more integrated into your space. It fits the whole theme of what each of you have kind of said about traditional and crypto just coming ever closer together and on every aspect, both from the talent side, but also the product and the regulatory side, and the feature versus bug actually, which sticks with me still. Sam, one last question. Your FTX Ventures Fund, we mentioned it briefly. What do you see as the most exciting opportunities out there for the VC world?
Yeah, I think that there's lots of exciting opportunities in sort of gaming and Web3 intersection. I think there's lots of exciting opportunities in bio right now. I think that there's a lot in the payment space. I think the biggest thing is I think that sort of a lot of the open opportunities are for a really sort of friendly VC firm that is trying to maximize the values of the companies along with the people it's investing in, rather than trying to find ways to maximize the value of its stake in the companies as divergent from the companies themselves. It's something I know we've been through many, many times. On the other end, seeing how much damage can be done to a company by having really restrictive conditions placed on it by investors for no particular reason, and I think investing in a clean way without restricting our portfolio companies is probably the single thing that we are most excited about.
The friendly face of the crypto VC. You heard it here first, I guess. Gentlemen, we've come to the top of the hour. I'd love to thank you on behalf of JP Morgan, of Onyx, on behalf of Christine, Harsh, and myself, and all of our guests online. Thank you for the time. It's been a fascinating discussion. Sam Bankman-Fried of FTX, Jason Urban of Galaxy Digital, Michael Morrow of Genesis Global Trading, and Wayne Trench of OSL. You've been brilliant. Thank you so much. I look forward to future discussions.
you.